All right, welcome everybody. So we are going to get started. So let me do a quick shout out before I forget, because sometimes I forget this part, which is actually one of the funner parts of doing this. All right, so let's do a shout out. I want to do a big shout out to Lisa and Troy, who put together this fabulous beach party with a bunch of investors, most of us females, okay, showing up. So just a big shout out to such a great community. They're so welcoming and everybody's, most of us are active investors. And so it was great just to have a social gathering at the beach, and just talking about real estate. So thank you very much for doing that. Okay, and then the other thing, of course, July 1st, we are Canada Day. Okay, and so big shout out to my fellow Canadians, and just want to say, how lucky and privileged I am to be Canadian. I grew up here and I have a fabulous life. And so, sometimes I think that I wouldn't be where I am if I was somewhere else, growing up somewhere else in the world. So definitely proud to be Canadian. So yeah. Okay, so that's the July 1st shout outs. Okay, so welcome everybody. We are July 1st and we are doing another session of Money Matters, of course, focusing on around real estate. So today we are going to be doing a pro and con list, comparing a few things. And the reason why I'm doing this is because a lot of the people I connect with will ask me, well, Hung, why this opportunity and not this opportunity? Or why this and not that? Or like, what about, like instead of doing the 32 unit opportunity that I'm working on, why don't you just keep doing private lending? And so I'll show you how I do the pro and con list, because every time I get an opportunity and I look at it and it passes the initial stages, then I'm like, okay, well, how does this compare to private lending? Because I do a lot of private lending. And then how does this compare to, say, doing the S&P or doing stocks or doing REITs or doing something like that, like an alternative strategy within real estate? Okay, so we will go through that. Okay, and so really the outcomes from these videos is to help fellow accredited investors make sound decisions in what they do with their money. Okay, so let's go into the pro and con list. And what I'll do is I'll bring up a whiteboard. Now, of course, keep in mind that everything that I'm sharing here is really just my idea. Okay, and so I just go and check with your lawyer, accountant, talk to other investors before you, take everything that I say, and implement it. Please take it with a grain of salt. I have an engineering background, but I do not have formal education in real estate, in the sense of like going to a university for real estate or for business. Okay, my real estate and business experience have been through coaches, programs that I've signed up for. So it's different from going to school. Okay, so just keep that in mind. All right, so let's jump right in. So okay, so here is, okay, I hate using the pen mark, so I'm going to be typing in the pros and cons. Okay, so here you'll see like a pro and then the con. Oh, okay. Okay, so whenever I look at an opportunity, I will compare it to what I would get if I was to do private lending. And so this is a question that comes up from a lot of my coaching clients saying, hey, Hung, why would I do a buy and hold instead of private lending? Okay, so keep in mind that the first thing really is that private lending and buy and hold are two completely different strategies. Okay, and so what you want to do is make sure that you understand both strategies and then consider the pro and the con of each one separately, and then make a decision based on, okay, for my situation, based on my knowledge right now, which is the best opportunity. Okay, so for example, like when I do private lending, I will, because I've been doing private lending for several years now, I know what all the pros and cons are. So like, for example, the pro for private lending is, a really high interest rate. Okay, plus lender fees, okay, plus legals. So that means that if I charge somebody like a 15% interest rate, I make a pure 15% return on that money. Then I will charge them legal fees and a lender fee on top. And that lender fee is my time, my administration to do all the paperwork, the maintenance of that throughout the course of the life of the loan. So that's definitely one of the pros of doing private lending. The other thing that I really like about private lending is that it's short term. Okay, so maybe 6 months to a year. The partners that I lend to, I call them partners because once I vetted them and they are good to go on that one project, I will usually roll that money into another opportunity with them after the term is up. So it's not just like a one-time transaction with me with my partner, like borrower partners. So it's short term in the sense that it's for that property, but then I will usually roll it over. Okay. The other great thing about having the con with the private lending is that there's a collateral. Okay, so collateral. Okay, sorry if my spelling is completely off. Okay, so there's a collateral, meaning that if something did go wrong, there's a physical property tied to it. So I usually will not do a promissory note because there's no collateral. Like a promissory note is just, I promise to pay you back, Huong. Okay, so that's not one that I would normally do. Okay, so the con about that is that, I'd like to say that it is passive, but it's not 100% passive, okay? So it's not 100% passive because I have to vet the individual. I have to do property research on it. I got to understand the market. I've got to be involved in all the documentation. And then I follow up with them like every 3 to 6 months, right? So it's not passive, but it's a great way to make cash to, fund your lifestyle. Absolutely. Okay. So now the other con is that if you don't know how to do private lending properly, you can have a very, high default. Okay. So even with my experience, I've now, because of the effects of the high interest rates and COVID, I've actually had some defaults in my private lending practice. So, years and years without any issues, and all of a sudden now I've got some defaults. Okay, so you just have to make sure that you can handle the defaults. It's not 100% guaranteed that you're going to get your capital back plus the interest. Okay, so just make sure that you are able to, to handle that risk of lost capital. Okay, so then what I'll do is I'll do the pro and the con of that opportunity. Okay, and then what I'll do is I will do a separate pro and con for the other opportunity. So opportunity A and opportunity B. So then I'll do another pro and con list. Okay, so, and then I'll go, so then here, so I'll type in, say this is opportunity A, and then this is opportunity B. Okay. So if you're not familiar with, let's just say, one of the opportunities and like you lack the experience in it, but you're very familiar with the other opportunity. So for example, I'm working on, let's say, this 32 unit new build, right? And I have a lot of people who are like, Huong, I don't understand new builds. I don't understand enough to make a decision here. Okay. So then my suggestion is, okay, then go take your money and go put it into something that you do understand for, that a year, 2 years or whatever, that is going to make you a return so that you're not losing out on an opportunity. Then take that time that while your money's busy somewhere else, then take that time to go and learn this new strategy that you don't understand, right? So then that way, when the opportunity comes up again in another year or two, you're able to take advantage of it if it's a right strategy for you. Okay, so for example, here, let's just say now, okay, so I'm looking at this private lending opportunity. So another con with private lending, okay, is that it's you can use borrowed funds to do that. Okay, so which is a pro. So I'm going to put that in under the pro portion here. So you can use borrowed funds. Okay. Now this was a great strategy. A lot of people I know, including myself, used our HELOCs, used borrowed funds, and then lent that money out. So, at that time, our HELOCs were like, say, 2-3%, or like even 4%. We would lend it out at 15, let's say, and then have to pay 4% fee on that to our banks. So then we were making, a 10-11% spread. Okay. So now the con, of course, is that it's borrowed funds. Okay. So that if it's borrowed funds and you go into default, well, you still owe that money. Okay, so borrowed funds. So if you have to borrow the funds and they go into default, well, then now you owe that bank, like you still owe that money to the bank. Okay, so just make sure that you are able to handle that that borrowed funds thing. The other thing too is that if you borrowed the funds and the loan hasn't come back, then you're paying, let's say, 8 or 9% now in the new interest rate environment, and you did your private lending at, say, 10% or 12%. Well, now your spread is only maybe 3 to 4%. It might not be worth the risk to put it into private lending when you can just put your cash into, let's say, a high savings account or a GIC and make 3 or 4%, 5%. Okay. So you sort of want to compare the pro and con, saying, okay, well, do I want to do a private lending opportunity, or do I want to just put it into a GIC? Okay. Or do I want to put it into a REIT? Okay. Or uh, let's see, what's another type of opportunity? Okay, so like the private lending or doing a flip. Okay, so it's the same type of idea. You want to do a pro and a con list for each of the opportunities and then compare the two. So the things that I look at when I'm doing like a pro and con list for all the different opportunities, I want to look at, one, how long is my capital going to be tied up for? Are we talking a year, 2 years, 5 years? And then once that capital comes back to me, am I getting 100% of that? Or am I getting 50% of my capital back, but then my capital, a portion of my capital still left in there? Okay, so that's two considerations there. And then the third consideration is, what is the return on my money that I'm going to be getting? Am I getting 10% on 10%, or am I getting 20%, or am I getting 30%? Okay, so that return on the investment is really important as well. Okay, then some of the other things that I'll consider, especially if I'm doing, let's say, if I'm going into an opportunity where it's like a GP LP structure, or like shareholders. Okay, shareholders. If I can type right. Okay, shareholders. Okay, so depending on, like, if it's a GP LP structure, or shareholder structure, then I'll run a pro and con list on both of those as well, because they each have a pro and con, and then I'll make a decision properly that way. So when I'm looking at the returns under the GPLP, shareholders, or private lending or whatever, I want to look at, okay, so how long is my full capital going to be tied up? When I get it back, do I have to use it specifically for something? So I bring that up because CMHC used to require that when you got your capital back, that you had to reinvest it again within real estate. And so there was ways to get around that, in the sense that, okay, well, when you have so many properties, you're obviously going to put that money to another property. That's not a problem. But if you're trying to exit real estate or reduce your portfolio, you're not going to want to put your money back into real estate, right? And especially in the environment where the interest rates are so high, you may want to just sit on your cash. So there was a time when I actually stopped doing JVs or partnerships, because CMHC's requirement on what I could do with that capital when it came back was limiting. And so now that restriction isn't there anymore. That actually got changed a couple of months ago. Okay, so then I will look at what's the cash flow, what's the appreciation, is there any cash call? Okay, and this one is a big one for me as an investor. So a cash call is like, it's like a special assessment on a condo. That's the best way that I can think to explain what that is. So when you get a negative cash call, that means that you as the investor, you as the person putting in the money, you have to put in some additional cash on top of what you've already put in to be part of that project. And so if you don't put the cash in, like if you don't have the cash for whatever reason, and you don't put in that extra influx of cash that they're asking you for, then you potentially will lose some of the equity that you have in that project, which is so crazy. So from an investor's point of view, that is a bit of a risk. Okay. And so if I come across an opportunity that has no cash call, like if there's a negative cash call, they can't come to me and ask me for additional funds. That is a pro for me, right? So depending on the opportunity, if there's no cash call, okay, so then that's where it's a pro for me. And then if it's like if there is a cash call, then that's a definite con for me. Okay, so then how long does the money, how long would the money stay out? Can I leverage that money even more? So when I say, okay, can I leverage it even more? If the funds are going to be returned back to me within, let's say, a year, 2 years, and it's not going to be tied up for 5, then that means I can take that money when it comes back to me in a year and a half, 2 years, and then deploy it on another project. So now I'm in 2 projects within that 5-year time frame compared to just being in 1 project. Okay, so you need to run your numbers on that. The other thing that I'm looking for right now all the time is, can I get infinite return? So the concept of infinite return is you put your money in and then you get that money back out within a short period of time or at some point in the future. And then after that, you still get equity. You still have cash flow, mortgage pay down, and appreciation. So if you're getting that and you have no money in the game, like no money in the opportunity anymore, and there's no cash call, okay, then that's infinite return. Okay, so that's one of the things that I'm looking for. So it's not necessarily I'm going to get cash today or next year. It's I want that infinite return because then that's, you know, how I can pass it on to the next generation. Okay, so those are the things that I look for when I'm doing that. Let me see what else can I share with you. So the amounts, how long. The other thing that I will look at is what is the taxation on the funds coming back to me? Is there a flow through method? So usually under the GPLP and the shareholders, we can structure it so that the capital that I invest in, when I get that back, that's just repayment of capital. So there's no taxation on that. The cash flow, mortgage pay down, and appreciation, there's ways to structure it so that it's not treated as active income or passive income. Like, so it's treated as just like a capital gains in the future. And so even though capital gains is increased now to 66%, it's still better to just pay, 30, 40, 50% of that 60. So really, at the most 33% or so in taxes compared to saying paying 50% on the passive income that would come from just rental income. Okay, so definitely talk to your accountant about that if any of that stuff I just said doesn't make any sense. Okay, so this is how I would run a pro and con list comparing 2 different opportunities or 3 opportunities. So I have a lot of individuals who are interested in doing, like, say, my 32 unit opportunity, and they're just getting into the multifamily, they're getting into new development. There's still a learning curve there. So one of the things there, you could put your cash and go take a course, or put your money in, learn about the deal, and make sure you understand it. And if you meet the criteria to invest, because as part of being in the opportunity is that you get to learn from that opportunity. Okay, so that is the session for today. So I think I covered all of my cue cards. Okay, so, oh yeah, hold on. So I did have a note here. Fees. You want to look at the fees that are charged and consider if that's a pro or a con. So for example, in private lending, the fees are coming to me. So that's a pro for me. Okay. But let's say in a REIT or in a MIC, if you're putting your cash into somebody else's REIT or MIC, you're going to have to pay them a fee, right? Whether it's 1%, 3%, or whatever. So you want to know what that fee is, how that fee is paid to them. Like, is it upfront? Is it regardless of how much I make, they still make that fee? Okay. How is that charged? All of that stuff. Okay. So you want to consider your fees, how long your money's staying in. Yeah. The other thing too that I want to mention is that if you are looking at doing, let's say, a REIT or buying another type of real estate stock, like a mixed stock or something, that is a great way to get into real estate because the amount to get in is very low. So, you could buy a stock for, $50, right? So that could be a pro for you, whereas doing my 32 unit build, you need like 100,000 to get in, right? So the price point of getting in could be a pro for you or a con for you. Okay. Now keep in mind that with stocks as well, is that you could buy the stock today and sell it in a week, right? It's very liquid that way. So that for me is a pro. Whereas in physical hard assets like real estate, it's usually not that liquid. Like it's like even with the private lending, it's not that liquid in the sense that, well, I can't just go and ask for my money back, right? So your money is tied up for quite a little bit of time. So you want to consider that fact as well. Okay, so that is it. I've covered everything that's on my cue card. So thank you very much for watching. If you have something that you want me to calculate, to share, please do so. Other than that, have a fabulous Canada Day, everybody. Thanks for watching. Bye-bye.